Richard, thanks again for your time speaking with Blue Notes. You've just produced this ANZ Research Quarterly where you run through the outlook for the year ahead, sort of globally, focusing on the next quarter, obviously. You had in there some quite robust GDP forecasts for the region, for the world, for Australia. There's been a bit of news since you put the work into this document, so I just wonder, has that forecast for GDP changed?
Yes, Australian GDP was very weak in Q3. We did actually put through a little emergency downgrade to our forecast, but we've just taken it for next year from a bit above 3 to a bit below 3. So that's still enough to get unemployment, keep unemployment coming down next year. We're hoping we start to see some stabilisation in wage growth, and those things will be sufficient to keep the RBA on hold. So growth, yes, is a tad weaker, I guess, in an accounting sense, but broadly we still think the Australian economy growing above trend. And that contrasts a little bit with the regional picture where for most of the small economies we expect you'll see some growth acceleration next year. Not a lot because the Fed's hiking and China is slowing a little bit, but certainly we don't think you'll see the regional fallout that you've seen the last couple of years as the Fed's tightened US liquidity, and that has negatively impacted Asia.
The next issue that you touch upon in the report is the global trend upwards in interest rates. We've obviously had some quite dramatic events, the Trump election, for example. There's a lot of uncertainty around whether that sort of trending upwards in interest rates is sustainable, is going to keep going. So keen to get your views on that one.
We do expect the Fed to hike relatively soon and then a couple of times next year, in fact, which is consistent, or broadly actually, with their own forecasts. One of the differences this time is because US rate hikes, we don't think will have that kind of big risk-off impact globally. It won't be enough to prevent the curve from continuing to steepen. So for investors, this kind of difficult bond environment where rates are generally going up, we think will persist. And for borrowers, they're likely to continue needing to look at how they're managing their borrowing exposure because it's going to be more expensive.
When we look at currencies, there's talk of currency wars, whether it's China and the US, but where do you see currencies broadly as we look out into the next quarter, the next sort of mid-term?
Look, the US dollar should be a bit stronger next year, but we don't think a lot, and we think the pressure immediately has gone off that currency wars kind of story. And the main reason is because this is not just a bit of a US recovery we're talking about, but actually the regional and global economy looks a little bit more robust. So countries will still care about growth outcomes, of course, and some central banks still have a very easy bias, particularly in Europe and Japan. But generally, I think currencies won't be the source of tension they've been on occasion in the past couple of years.
For Australia and other resource-producing countries in particular, the commodity story has been a positive surprise. Is it something that's going to continue as we look out?
Yeah, so we've had a few drivers of the positive surprise in commodities, and actually we think those drivers will persist. Demand's been a bit stronger. You've also been able to identify that kind of US dollar influence on commodity prices where that big dollar squeeze was driving prices down. That started to diminish earlier this year. And perhaps most importantly against that backdrop, producers in most commodity segments are either actually unwilling or simply unable to increase production. So in a sense, you've got all the main components in commodity markets contributing to some stronger prices, and we think almost across the board, those stronger prices will persist next year.